Buongiorno a tutti e benvenuti al primo webinar del nuovo anno, organizzato da ARRA in collaborazione con HDI Global SE. Non potevamo iniziare il nuovo anno meglio di così. Quello di oggi sarà il primo di 3 webinar, grazie ai quali tratteneremo e analizzeremo il tema delle captive a 360 gradi. Siamo fortunati ad avere con noi quest'oggi degli esperti dell'argomento che ho l'onore e il piacere di presentare. La dottoressa Ania De Marta, Captive Portfolio Manager and Fronting Expert from the Captive Services Department, HDI Global SE, e Tiziano Toffolo, il dottor Tiziano Toffolo, Chief Underwriting Officer, Short Tail Business, HD Global Italy. La moderazione del webinar di oggi sarà a cura di Marco Terzago, presidente del Comitato Formazione ARRA. A tutti i partecipanti ricordo che il webinar di oggi sarà svolto in lingua inglese e che al termine sarà possibile partecipare al test ai fini della certificazione RUIVAS, per il quale tramite la nostra segreteria ARRA abbiamo già inviato le mail con tutte le indicazioni. Quindi senza indugiare, senza perdere tempo ulteriormente, lascio la parola a Marco per la conduzione dell'appuntamento di oggi, augurando a tutti i partecipanti buon webinar.
Grazie mille Luca, buongiorno a tutti anche da parte mia, Grüß Gott per gli amici di Monaco, good morning everyone, and guten Morgen. So I start speaking in English, if you don't mind, of course. You know that the webinar will be in English, so but if anyone is having any trouble with the language, with the jargon, with anything that our friends from HDI will say from now on, of course, use the chat. I will very much encourage you to use the chat, and I will ask. I will be the one asking our speakers any clarification, any deep dive into more details. So please do it. So it's my very pleasure to introduce more in detail Ania and Tiziano. So Ania is in the insurance industry in Germany and in Switzerland since 2007, and she's working in the Talanx AG HDI group since 2015. So initially you have been working, Ania, in the personal lines international, dealing with Central and Eastern Europe and Latin America. Good combination, I would say. And since July 2023, you are in the industrial lines in HDI Global, and you work for the headquarters, which are in Hanover, but you work from the very nice town in Munich. You are married with a mathematician, so I think it's a good combination. No? So you have a good, quantitative background also in the family, not only in your professional life. And as a hobby, you share, of course, numbers, learning new things. That's very, very good. And mountains, you like skiing, and that is your season, I would say. And it's also my pleasure to introduce Tiziano. Tiziano, we basically we can say crossed our professional lives a little bit in Pirelli. So you are in the insurance and risk management industry since 2004, and you have been working, I have said, one of the company you have been working to in Pirelli in Milano from 2004 until 2013. And from 2013 to 2022, you have been in Fried Chrysler Automobiles, now Stellantis risk management department, and also you have been working from Switzerland, I believe. So you are in the HDI Global, the Italian branch in Milano since September 2022 as a chief underwriting officer in charge for the short tail business. You are married, you have 2 kids, and you also share with Ania the sport. Favorite sport is skiing and snowboarding, and of course football. We both are fans of the same team, which we don't have to say, of course, not. So that is the presentation of our 2 very, very skilled speakers today. And as Luca has mentioned in the introduction, of course, this is the first webinar of a series of 3, which Ara is doing with the help of HDI Global. This first webinar is focused, as Luca said, on the understanding of the basics of the captives. So how an internal insurance company is working and how a captive can make sense in the doing good risk management for a corporation. The second webinar will be on the 25th of February, so you note on your calendar, same time from 9:30 to 11, and the focus is learning more into details how captive concepts are used into practice, and we will have a deeper overview on the technical aspects, and we will also invite some risk manager to get the risk manager points of view. And the third webinar on the 25th of March, always 9:30 to 11, is more focused on ART, so alternative risk transfer solutions. With that, we mean a risk retention, risk transfer concept beyond the traditional captive concept. So understanding different type of ART solutions and how to use them to sensibly, let's say, with or and without captive involvement. So no other words from my side, and I'll give the word to Tiziano for an introduction of the Talanx Group and HDI. Thank you, Tiziano.
Okay, thank you, Marco, and thank you to Luca. Yes, for this.
Sorry, the screen share. Now, okay, I have it. Sorry.
Okay, coming.
No problem.
Okay. Okay. So thank you, Marco. Thank you, Luca, for the introduction, and thank you, Ara, for giving us the opportunity to being hosted for this webinar. I welcome again everybody for attending this event. And as Marco said, I encourage you to maybe interact with us. Should there's any concept that you want to get clarification or to have a better other information, or if there is something that is not super clear, particularly for what concern the terminology and the technical aspect. Before we go to the main topic of this webinar, that is basically captive, and Anya will have the pleasure to introduce, and she will do it definitely much better than I can do it. We would like to give you, let's say, a quick overview of who we are, because it is important also for what concern the captives to understand and to define which could be the appropriate stakeholders and counterparts to work with. We will have the chance to speak about this going forward in the webinar. So I'm gonna give you just a very quick snapshot of what who HDI is and the group that we are representing here. So we both, Anya and I, worked in the Talanx Group. If we can go, Anya, to slide 3. Yes, please. Yes.
It doesn't. Does it do it?
Work?
Ah, yeah. Now, okay. Yeah.
Okay, it's working. Okay, good.
Yeah.
Okay. We are HDI. A Talanx Group. So we are part of the Talanx Group. Talanx Group is among the top 10 largest insurers or insurance group in Europe, and basically we were at number 6 in terms of insurer revenues, which should be at number 5 based on results of 2024 that are not yet published yet. So basically all the numbers that you're going to see here are basically related to 2023, because of course we can provide you with only the official data. We work in 5 continents, and we are operative in more than 175 countries, and we are one of the oldest insurance group in Europe, because we are operating this for more than 120 years. We are rated A+ in Standard & Poor's and A+ in AM Best, and this is one of the most important thing when you are considering an insurance and a reinsurance partner. We have more than 24,000 employees all around the world, and half of them, or more than half of them, are located out of Germany. And when Germany is where our headquarters is based. Annie, if you can turn to the presentation mode, because maybe it's easier for the people to follow.
I am actually in the presentation mode, so that's why I'm a bit confused why it doesn't show. I have to maybe here, like if I share it like this.
Not yet.
Okay.
It's
No, is it
the other way around, because you are sharing
okay.
yeah, that's
Does it do it
Okay,
now?
that's great.
okay.
That's great.
Oh yeah,
Okay,
now
good. So
it does
here
it.
we are.
Okay, sorry, there
Okay.
was a
So this is,
GoToWebinar failure
yes,
here
this
for
is
me.
the first attempt for us too. So in the other webinars, we will be much more experienced. So Talanx is a sort of conglomerate that takes into consideration what we call business areas. So we have the industrial lines where we are as HDI Global. So we are one of the daughters of Talanx holding company. Then we have the retail business in Germany, and the retail international, where basically we are also famous here in Italy for HDI Assicurativi, which they are our cousins here in Italy. Then we have the reinsurance division with Hannover Re, that is one of the third largest reinsurers in the world. And then we have all the financial services. So focused on the industrial line, so where we are as HDI Global SE. So we have insurance revenues worldwide as HDI Global SE close to 10 billion euro. In 2024, we're gonna overtake also the 10 billion euro revenues. We are operative in 5 continents, and in the next slide, Anya, this is how we operate. So because the network is one of the most important standpoints when you are talking about insurance capabilities concerning the service to the captives. So in order to stay focused on the main topic of our seminar, we are operating in 39 countries with our own branches of subsidiaries, so basically our own companies. But then we are able to provide service in more than 175 countries, as I said before, thanks to the network and the network partners that we have created and operating all around the world. We are leading currently more than 5,000 international programs all around the world for our line of business. Yeah, and we are one of the oldest division of our group, because basically we have been founded at the beginning of the 20th centuries, and we are more or less 4,500 employees all around the world. So this is just to give you in a snapshot the size of our group and how we operate all around the globe. In the next slide, you're gonna see the geographical distribution of our companies worldwide, where basically the dark green countries are the countries where we have our own subsidiaries, so controlled entities where we operate, and the light green countries is where we have network partners, so where we can reach our clients indirectly providing services, and there are other countries where we can provide individual solution, let's say specifically on purpose for our clients. So this is just the brief introduction of who we are. Then I will leave the floor to Anya to go very deeply into the purpose and the main topic of our webinar. Thank you, Anya.
Thank you so much, Tiziano. Hi, everyone. My name is Anya. I work for HDI Global in the Captive Services Department, actually for the head office in Hanover, but I work out of the Munich branch. This is quite normal in HDI that people work for head office but are based in a branch, because the business actually happens within our branches, be it internationally or in Germany. Within Germany, we have a couple of branches as well. First of all, what is a captive insurance company? It is an insurance company that is wholly owned and controlled by its insureds. So by, in our case, because we are an industrial lines insurance carrier, by our industry clients. You could actually say that almost all of the very, very large industrial companies run their own insurance companies. Very often they are reinsurance companies. And these are the so-called captives. And this is their way, the industrial lines clients' way of retaining risks themselves. Captive services, that's the department I work for. We are 4 people. We are in charge of the captive relationships worldwide, except for the US. The US has their own captive services division, and France as well. And France for a very particular reason, because within HDI France, we are also managing other alternative risk transfer solutions. So if you join the webinar late March, you will hear from our French colleagues who will tell you a bit about the solutions we are offering there. So they also have captive services department. And what we do is very important to understand, because we are not a traditional operations unit. We have more of a holistic view on the captive relationships. So we are responsible for the approval of a certain fronting we do. Fronting means that we would insure the captives and place part of the risk with the captive. And it's very important that we do that by assessing the default risk that comes with such a relationship. So we look at the balance sheets and solvency reports of each and every captive we have a relationship with and try to understand, will this captive also exist in the future? Or is it likely that it will have difficulties or go bankrupt and so on? We are also in charge of the profitability of our relationship with captives, because we as HDI Global, we don't do the collaboration with captives because we are such nice people, but because we want to make money. So it costs us. It's operationally challenging to work with captives. We as an insurer, the so-called fronter, take over part of the services, especially in claims and so on, and in administration. And we want our clients to pay for that and to also make profit from it. We are in charge of the contract design that we have with the captive. And as I said, most captives are reinsurance companies. So in most cases, it's a reinsurance contract. In some cases, captives have their own primary direct insurance license. Then it's like a co-insurance agreement, so to say, with the captives. This can exist too, which for an international program, we will come to that later, is pretty much also a reinsurance agreement. What we take over is internal and external consulting. It's presentations like the one I'm doing today that we deliver for clients or for networks like the Risk Manager Network. We sometimes consult our underwriters internally on the setup and the structure of certain fronting deals. And this is important to understand. We as captive services, we don't have a sales role. So we don't have any sales targets. We are approached by our underwriters. So if Tiziano, for example, says, hey, I have an Italian client who wants to involve their captive, please check it, assess the deal, put a price tag on it, and so on. So we are no sales unit, but the underwriters get active and bring us the deals, and we consult with the underwriters and the captives directly, and the client, of course, for how to structure a deal. And because we do it this way, and we also involve the brokers, of course, we are very often finding very tailored solutions. So what we do here, this is not like it is big numbers, it's big premiums, but it's very boutique. So it's really very individual for each captive client that we have. And for the basics, on the left side, I show you the basic setup that we have for most captive deals. And in this setup, the captive acts as a reinsurer. So you in the general setup, you have a normal insured. In our case, it's an industrial company. And this insured has an agreement, an insurance contract with a fronter, with an insurer. That's a normal, let's say, for example, a property insurance contract. And they pay premiums for it. And we as an insurer, as HDI, we pay the losses. Then we as HDI would involve the captive as a reinsurer. And the interesting thing about this captive is that it's fully owned and capitalized by the reinsured themselves, by the industrial lines client. By doing it this way, in this triangle, it means that the insured retains part of the risk via this reinsurer. And this is really between us, the fronter, HDI, and the captive, the reinsurance company. It's a classical, normal reinsurance contract that needs to be renewed every year. So we have to look at all the agreements every year. We have to look at the stability of the captive every year. And we are getting reimbursed if losses occur. So this is the basic concept. One important thing is that what is a bit different in this construct between a normal insurance setting and a captive involvement is that in many agreements, we do it in a way that the captive has to pay us, the insurer, first before we pay the client. We call it pay as paid. In many contracts, we have it like that, which is unusual for an insurance relationship, because usually whenever we have a claim occurring, we would have to pay as an insurer. But in some cases, it's also like that we have to pay, and then after that, the captive reimburses. But this is a bit non-traditional, that in many cases, the captive has to pay first. So the chain is pretty much reversed in claims payment. I understand that the concept of captives can be a bit hard to tackle at the beginning. And that's why I really ask you to, if you have a question or if I'm talking too quickly, please let Marco know. So he will ask me the questions right away, because I don't want to go over and then you get lost. I really want you to involve in the talk if you don't understand anything. Yes, so that's the basic concept on the left-hand side here. And then, of course, these captives need some services during the lifetime. So there's the initiation phase, when a company thinks, should I set up a captive? And if yes, how should we do it? It's the feasibility assessment, where they look at the price points and how much it would be to run this captive, how they would set it up, how they would structure it, where would they set it up? I mean, it's a reinsurer. Should they set it up within the European Union, in the US? What is best regarding taxes, regarding risk, and so on? These are super complex topics. And I have to admit that we as HDI, we don't do that. So we don't offer consultancy services in that realm. The usual suspects here would be the big brokerages who do that, but there are some that are really focused on captives only. The usual names you would have with brokerage like Aon and Marsh, they do it, of course, but we don't engage in that. Where we are very active is in the running phase. So once the captive is founded, to keep it up and running, to ingest the insurance contracts, reinsurance contracts, and so on. And there what our department does is the global fronting. So we act as a fronter, as an insurer in front of this reinsurer. What HDI can also offer is asset management, because the captive will have assets that need to be managed. And this would be, we could offer through our investment arm. It's called Ampega. And what we also do within HDI is offer reinsurance to the captive, because the captive might write different lines of business, would need some coverages behind the captive. So this would be something behind the captive, another reinsurance contract. We can do this as HDI Global SE. And this is something that our French colleagues will tell you in the webinar in March, how we would usually approach that. But we can not only manage it via HDI Global, but also via Hannover Re, because within Talanx Group, we have the third largest reinsurer there is in the world. It's Hannover Re, and they also provide these services to captives. What we don't do at HDI in the running phase of a captive would be the ongoing captive management. This would also be usually managed by the brokerages or the specialized service providers, and the reporting and regulatory filings. And this can be really tough and heavy, because you probably all work in risk management, maybe have to do with the regulator. This can be tedious in some domiciles to work with the regulators. Another thing is the runoff you would need when a company says, I want to discontinue my captive. I don't want to use it in the future anymore. Then all the business that exists within the captive and all the reserves that there are need to go into runoff. And this can take a long time, especially for the long tail type of business like liability, clinical trials, and so on. This will take forever. And there are specialized providers for that, runoff companies. We don't do that. When we have the case that a client wants to put their captive in runoff or one line of business in runoff, what we can offer is that our actuaries would turn these reserves into one-time payments. Then it's done, then we close the deal, but we cannot do runoff services. What's important to know is the perspective, or to understand is the perspective of our clients, of our industrial clients, the reasons why they would involve a captive or have an own captive. Because I mean, it's a big deal, right? Having your own insurance company with all the regulatory filings and all the capital you need to run it. Why do they do it? And very often, this is the actually the cheapest and sometimes only possible way of transferring certain risks from one legal entity to another. Imagine you are a big industry company in Italy and you have operations or a factory in Brazil, for example. And the factory is not so big, the tax environment is not so attractive. You don't want your capital to be stuck in Brazil, so you capitalize it as low as possible. And let's say there's a fire there in Brazil and you would suddenly need money there. And if you don't have a captive or a good insurance program, your only way to get your money from Italy to Brazil is to place capital into that Brazilian unit. And this would be taxed heavily in Brazil, in other countries as well, because it's a capital provision of a foreign company into another company. And that's why very often for these types of companies, the only way to have it smoothly, efficiently, and tax efficiently run is via an insurance setup. And how the international program is run, I will show you later. But this is a very, very smooth and easy process. I will show you. Another reason for many companies is if you have very unconventional risks, like new methods of production, for example, that the insurers don't understand or don't have in their portfolio yet, the insurers would be quite reluctant to insure it. Then you need another solution. And we as HDI would very often say, for example, okay, we wouldn't write this risk in our books, but we write it as a fronter if you take part or all of it in your books. Then we do it. This is also interesting for risks that are very low frequency but super bad in severity, like clinical trials, for example. It's not that it's an unconventional risk, it's a risk that we've known for a long time, but this is usually something that insurers are so keen to write, but with captives you can write them. Another advantage if you have a captive is that you can access the reinsurance market directly. So now imagine you are this Italian industrial lines or industrial company, and you want to reinsure your factories, for example, and you're really big, so you need a lot of capacity. You can access us and Allianz and so on, like the normal primary insurers through your broker, but you wouldn't be allowed legally to go directly to the reinsurance market. You could access Swiss Re, for example, Corso, like the primary carrier of Swiss Re, but not Swiss Re as a reinsurer. To do that, you need to be either a primary insurer yourself or a reinsurer. And what you very often see in the market is that the reinsurance market is a bit cheaper than the primary insurance market. Another reason why our captives do that is to give a signal, and not only a signal, but these are usually companies that are very good with hands-on risk management. I like the example of a certain line of business. It's cyber. We as an insurer really like companies that have skin in the game, so who participate in the risks with cyber, because there it's really important to be on top of things, to have your risk management under control. And if you do that actively and orchestrate it through your captive, and if it really like influences your profit, it's taken seriously. So it's really good in risk management, and to have an overview of the whole insurance program and the risks in the company. So now this is the client's perspective, why they think about it and why they would have a captive. Now our perspective as HDI, as an insurer. So why are captives different from the collaboration with traditional reinsurers? First of all, most captives are smaller than traditional reinsurers, so they have less capital, and most of them are not rated by Standard & Poor's or AM Best or Fitch, because ratings are super expensive to obtain. You have to renew them all the time, and they would probably not get a very good rating because they have less diversification than traditional insurers, because they are actually only insuring one client or a group of clients. And that's why they are very different from traditional reinsurers, and that's why our team exists, because every year we have to look at the balance sheets, and if it's a European captive, we would have at the solvency reports and so on, to really see, is something going wrong there, or is this a stable thing? What's also different is that because the risk owner and the captive owner is one entity, there's a symmetry of information and a symmetry of interest in such a deal. And that's exactly what comes into play, like in the cyber example that I mentioned, that this is different from the other reinsurers, because honestly, the other reinsurers have a huge portfolio and they don't care about that one reinsurance deal. Because captives are smaller and because they are less diversified, they are very often much more risk averse than normal reinsurers. I mean, they know that they need to have at any moment in time a certain capitalization, because otherwise the regulator will say, no, you have to discontinue operations. And they, of course, also have an interest to make a profit with that captive. And to make a profit, you cannot underwrite bad risks, right? So you cannot do that. And you cannot do cowboy deals that are crazy, because you want to have a good relationship with your insurer, with your fronter in the future as well. So you have some reputational risks as well. And that's why they tend to be much more risk averse than the normal reinsurers. Yeah. So this is our perspective and why our department is needed. And then a bit more about our role as a fronter, as a primary insurer in this setup with the captives. Most captives, here it says in Europe, but this is also true for the US actually and Asia. In the US, the captive market is very developed. In Asia, not so much. Europe, so-so. Most captives are reinsurers only. And this makes a lot of sense, because the regulatory requirements for reinsurers are much, much lower than for primary insurers, because a reinsurer is always in a B2B relationship. Only an insurer can insure with a reinsurer. With a direct insurer, with a primary insurer, normal clients, ignorant clients can make business. And yeah, and that's why it's much easier to run a reinsurance company. And it's also more efficient. I will show you later which role a captive plays in an international program. And it's very often enough to only have a reinsurance license. we only have very few, the biggest of the biggest clients who run a primary insurance captive, and they then act as co-insurers in international programs, not solely as reinsurers. But this is really only interesting for very few companies. And the third point here, A-rated admitted paper is required. This is super important. These captives that are primary captives usually also get a rating, because in some countries, to insure risks, you need to prove that you have a certain rating. I'm talking about some disability workers' compensation coverages, for example, where you need a minimum level of rating to actually be allowed to write them. Can also be some property coverages in some countries. And to have that rating, to keep getting the rating, requires a lot of capital, a lot of stability, a lot of professionality that most captives don't have. That's why I will focus in this webinar more on the reinsurance captives than the primary insurance captives. And then you need a fronter if you have a need for local policies. So think back to that example of the Italian company that has a factory in Brazil. This factory then needs to prove to the Brazilian government, for example, that it has certain coverages and that it has it with a Brazilian insurer, so to say. And when we build up an international program, I will show you a picture later where you see that we would issue then a policy, a property policy, for example, in Brazil with our Brazilian branch. They would issue this paper. And if we don't have a branch or an own carrier, we would issue it through our partners. Yeah, so to sum it up, the fronter is very important because most captives are only reinsurers and they need a primary insurer to write the risks, and in international programs. And I will come to that now. So how is the captive now typically involved? First of all, let's look at the setup in the program. So because it's more advanced, I will come to the international program later. But there's actually two fundamental ways of setting up a captive program. We see usually a net program. That's the one depicted on the right side. But I will start with a gross program because it's probably a bit easier to understand. So in a gross program, HDI would write all the risks from the client. So to the left here would be the client. So HDI would write all the risks. And then with a reinsurance contract, cede it. So ceding is the act of reinsuring to the captive in full. And then the captive would retain part of it in their own books as a reinsurer. And part of it, the captive would give away, would retrocede. So retrocession is the cession of the cession to a panel of insurers, reinsurers, and very often HDI. This is important. HDI usually wants to have a skin in the game. When we do fronting, we usually want to participate in the risk as well in our own books. We have some agreements with companies where we do so-called pure fronting, where we just cede everything to the captive and don't retain anything in our books. But we have to be very careful with it, because if you don't retain anything and do the pure fronting, the regulator could come and say, hey, this is not an insurance contract, this is actually a service contract. And then in some countries, you could run into tax issues if you do it that way. And that's why we do pure fronting only under certain circumstances. And these circumstances are, for example, if we retain part of the default risk of the cap, so then we still have a financial risk in the deal. Or if we can argue that we participate in the risk transfer for another line of business, for example, for the client. So it's the overall relationship where we still retain some risk. But this is something you have to be a bit careful in captive fronting, that it is not only a service contract, but a real insurance agreement. Most deals are not gross programs, but net programs. In a net program, HDI again writes the full risk on their primary paper and then would cede only part of it to the captive and usually retain part of the risk or ceded directly to a panel of reinsurers. So that's what we see, I'd say, in like 70% of the cases, a net program. And why we see more net than gross programs is quite easy to understand. In a gross program, 100% of this thing is ceded to the captive. So the captive has an initial exposure that is as high as the full limit, so to say. And in a net program, the initial exposure of the captive is only this little square. That's why it's much less capital that is required for the captive to write a net program than a gross program. What we also do when we initiate such a deal is that we offer engineering services. We also require this with some types of risks that we send our risk engineers out, especially in property, to look at the risk and to be on top of that. And in some jurisdictions, this is also required. Other than that, this is depicting a gross program. That's what I've already talked about. And another thing that is very interesting and that we also do as HDI, imagine there's a captive and the insurers can be any insurers. In this example, it's always light green what we do. Let's say HDI only fronts for the liability risk, but the captive is also writing cyber and property damage business introduction, so PDPI short, with another insurer. They have a portfolio of risks and they can bundle it and then retrocede, so reinsure part of the risk, for example, with Hannover Re. So Hannover Re does that, reinsure the captives, or they have a panel with HDI and Hannover Re and other insurers. So this is very important that the captive also takes out reinsurance, that we are sometimes also involved in these types of deals. And sometimes this is also our solution to not end up in a service contract, as I showed you before. So if we have a pure fronting, but we take some risk, let's say on a multi-year, multi-line, or only multi-line single year reinsurance session, then we can prove, hey, we also retain something. So it's not only a service. So that's the general setup of how you can structure these deals. And to have it more systematically for you, this slide is really good. Because it's possible, like, think again about this Italian company that would have operations in Brazil, for example, and so on. Probably this company would be able to cover some risks through deductibles, but they might vary in each country. So it might be that Brazil could only cover 1 million on their own because they just don't have enough capital. But other countries like Bolivia could cover 7 million. And of course, it's the most efficient way to cover a risk or to be able to cover the risk through a deductible. Just retain it, just pay it on your own. But it might be the case that the local companies of this parent company have very different ability to cover such risks. And that's why the deductibles might be very different in these countries, and due to capital restrictions that you have. And a smoothing element could be to then involve a captive. And then you say, okay, then I have a deductible. It's a different deductible in every country. And then on top, the next layer, so we call this layering, this dark green layer would be the captive layer. And pretty much HDI issues a contract that would start over the deductible and would contain all the risk. And this layer up to 10 million, they would cede to the captive. That's the captive layer. And this is, of course, more expensive than having just a higher deductible. I mean, you could say, oof, I could just make higher deductibles. But yeah, you probably cannot in every country because you probably don't have enough capital in each country. And if the parent always has to pay on the spot, it will take forever. It will cost taxes. So it's much more efficient to do it through a captive. And by doing that, by running a captive and having a captive layer, you have a layer, a captive, an instrument that can also be a profit center, that can also gain some profits on the capital you have invested in that. So this could make it very attractive for companies in a certain size. Then usually when you have really big exposures in property, for example, so we see clients that have exposures that exceed 1 billion euro per year, then you would usually have a layer that is on top, a market layer or several market layers or access layers that are within this program. And this is usually really too high for the captive to cover. So these are usually where you cede to the market. We like it very much in HDI to participate in these layers as well. And that's where the normal insurance market is involved. So this is like a classical layering structure of a captive fronting. Yeah. And these layers, so the captive layer 1 and 2, this is pretty much the one I've showed you now. This is the most usual. So I would say I see almost 90% that are structured like this, and it makes sense because the most expensive layers are the bottom layers, because that's where you are most likely to have a claim. And this is super efficient because so these are the most expensive ones, and most clients have the idea when they have a captive to take away these expensive frequency claims. So they are quite predictable, especially in marine, when it's about transporting goods, and they understand, on average, I have to do that many transports per year. And honestly, in marine, there's always something happening. So with these high frequency lines of businesses, it's very efficient to put them in the captive. So that's the most traditional one, what you see here as 1 and 2. In number 2, you see this different deductibles in each country. What we don't see so often is a captive, that's the third one here, in the Excel layer. So in the excess coverages, in the further up layers. This is usually something that we see when a client thinks, hey, in this layer, the market is really overpriced. I'm much better as a risk. I don't want to pay that. Sometimes you see that also if companies don't find coverage. So if they have a risk that's maybe not so attractive in the market, then you every now and then would see a captive in the Excel layer as well. You can have it paired that they participate partly in a further up layer, but this is like really some more sophisticated stuff, and we don't see that too often. Within gross programs, this is what I already told you before. So that's the fundamentally different structure, the gross programs. You have the deductible, of course, and here to the left would be HDI. So we put everything into the captive, and the captive would then give it away. So that's the fundamentally different structure, the gross structure. So please take your time to look at it when you have time and to really think it through, like, how does it make sense? Usually it makes sense to involve the captive as far down as possible so that you have most savings in your insurance program, because that's the most expensive part of it usually. What we would do as a fronter as well is if we do all the primary insurance relationship, we are also in charge of the claims, right? So if you run your setup that way and have a fronter, you don't need a claims organization within your captive. And that's also why most captives don't have primary licenses, because it would just be crazy to run so many primary insurance relationships and claims. International program, that's my favorite topic, and that's really where you have to think. So this is a typical industrial lines international program with captive involvement. Let's say you have a client in the UK, and this client wants to insure property risk. And so this client approaches HDI UK, the local branch office. We are also opening a carrier this year in the UK, so we will have both abilities, branch and carrier abilities in the UK. And they will close a deal, a master policy. And this master policy is pretty much orchestrating the whole international program. In this master policy, they write all the terms and agreements, the limits, and this is the mechanism to smooth out differences in limits and coverages that we have locally, because in some jurisdictions, in some countries, you're not allowed to offer certain types of coverage. In some jurisdictions, you have maximum limits that you're allowed to write, or minimum limits that you really need to ensure that you insure there. And the master pretty much catches all these differences within the international program and brings them to one standard that is governed by the master. And each and every claim is also led through the master. And I will show you how it's set up. So this company has operations in the US, in Brazil, and in China. And in all of these countries, they have properties that they want to insure. And these are insured with our local branches or carriers of HDI. In China, we don't have an own branch. We do it via a network partner. In China, it's Ping An. And they insure normal local policies. And it's important because they have to show to the local government and the local regulator, yes, we have insured our risk with an admitted local carrier. And that's what we can insure in over 170 countries. So they close these deals. And then the carrier, so HDI USA, HDI Brazil, or the network partner, cedes, so reinsures these risks with our captive, with the HDI captive. It's called HGN. It's HDI Global Network. It's a reinsurance company. And they orchestrate, they take in all these primary insurance risks and cede it 100%. So that's a pure fronting. They cede it 100% to the producing office. And in this case, this is HDI Global UK. So this step routes all of the business to HDI Global UK. So it's in the top line and bottom line of HDI Global UK. And HDI Global UK can always check, because the claims management is done locally, because the local insurance contract is locally. So they pay. They only look at this local policy. But HDI Global UK now can ensure that all claims that were paid in the local policies are checked, for example, for aggregates. It could be the case that one claims event, like, let's say, a thunderstorm, would ruin factories in the US and in Mexico. So it's one claims event, and we have one limit. So they would check, hey, how do we apply our limits? They would check, did we pay not enough because there's a limit that we can pay in this country, but the client, because of the master policy, would be entitled to much more money. They check that. What they also do is they orchestrate the premium payment, right? Because we collect all the premiums in local currency locally. And then through this session chain, our captive funnels it and then routes it to HDI Global UK, who's in charge. And what they can do now, the HDI Global UK colleagues, they can now make a reinsurance contract with a captive. So you see, you have all these local policies, and through one reinsurance contract, you can involve the captive. So you can say, okay, let's say everything up to the first 20 million we cede to the captive, or we involve the captive in a quota share with 20%, also possible. So they can now, with one contract, capture all these primary insurance contracts with the captive. There is some exceptions to that for legal reasons and tax reasons. For example, if we surpass a certain threshold, we need to have a direct session from the US to the UK here. So we have to circumvent this network. But this is really exceptions. And this is usually the US, sometimes Argentina. So this is really this is advanced. This is next level fronting. But it happens. It's a pain in the ass, but it happens. But usually this is the setup. And that's like the very standard international program setup that exists. Okay. Yeah, then when now you are risk managers of companies, so you wonder, hey, what is actually the thought process of a company that would consider forming a captive? The first question is the one I touched already, like the deductibles. Wouldn't it be easier to just increase the deductibles? So if this is enough, So if you feel like the lowest deductible you could have would be enough to cover your risk sufficiently, it's of course much more efficient to just increase the deductibles. Then you also have to wonder, hey, are these risks actually suitable for a captive? So is this something that I want to have in my books, or is it not really suitable for a captive because it's a coverage that is so cheaply available in the market that it actually doesn't make sense? Then you might think, hey, why bother using a captive? What's my risk appetite? Is this something I would rather have the risk, or is this something I really want to seed out, that I don't want to have any dependency on? Then the part in the middle is super interesting, how to run the captive. Like, do I have my own captive? That would be, we call it single parent captives. That's a captive that is owned by one parent only, by one industrial company only. Or do I use an existing structure of some service providers, such as protected cell company, that's the PCC, or incorporated cell company? So brokerages like Aon, for example, or Somage or Willis, they are offering companies that consist of a core with surrounding cells. And the core is pretty much run by these companies, by Aon and so on. And the core in a protected cell company setup is the only, how would you say, like heuristic person, like they orchestrate all the deals, they approve the frontings and so on for the cells, but the cells, the assets of the cells are segregated against each other. Oh, we call it legal persons in English, yeah. So it's only the core is the legal person. The core would write all the reinsurance contracts, but the cells would own the assets and are segregated from each other. That's the protected cell company. And the nice thing about them is that you can set them up immediately. So it's quite easy. You just make a contract with Aon White Rock to participate in such a structure, and boom, off you go. You have your license. An incorporated cell company is pretty much the same as the protected cell company, with one difference, one important difference, is that the cell itself is a legal person. So the cell itself can write contracts. And that's much better for the fronter actually than working with a protected cell company. So you can look up these concepts. I think it's very interesting to understand them. It's also important to understand that these types, protected cell companies and incorporated cell companies, you can only run them in very few domiciles. So in Europe, this would be Malta, for example, and in the US, in Vermont and so on. In many US legislations, you can do that. In Italy, you cannot. So in Italy, the only way would be a single parent captive, same in Germany. Also in Luxembourg. Luxembourg doesn't offer protected cell companies. Then you should wonder, hey, do I need a primary insurance license, or is it enough to just get the reinsurance license? So as I said, it's much easier and lighter to only get the reinsurance license. But if you want to also work as a co-insurer in some setups, then you need the primary insurance license. You also need a primary insurance license if you want to offer coverage, other coverages, maybe coverages that you offer to your clients. We see it with some electronics companies, for example, that want to have a warranty coverage for their clients that they write directly. Then you need a primary insurance license, of course. Another question then, the domicile. The nice thing about a EU domicile is that you can, if you want to be a primary insurance captive, that you can write with freedom of services a lot of risks directly through this license. Another way of thinking could be, hey, where can I save taxes? Because of course this captive will probably write some profit, or hopefully it will. Then the tax question is much more important. Domicile question could also be led by, what's the minimum capital requirement? Do I need to publish solvency reports, for example? So you really need to understand what does the regulator want? Are they very friendly towards captives, or are they very strict, for example? Do they have own captive legislation? Because in Germany, for example, it's quite tedious because there's no special regulation for captives. This is very different from Luxembourg, for example, where there is. France has just issued a new captive legislation to be more attractive for captives. So these are all things to consider. Within our book, the majority of captives are domiciled in Luxembourg, actually. Then some Malta, and we are building the US books quite considerably. Yeah, so these are the basic questions to ask before forming a captive. And then once you have figured out, hey, I want to run, for example, a protected cell company in Malta, then the big question is, how much capital do I need? What's the regulator asking me for? What do I feel comfortable with? And what's the front desk point of view? And this is where our department comes in. So if we see a captive that is retaining a solvency ratio at a very low level, and we think, hey, so if there's one claim coming in, the whole thing becomes unstable, we will either reject to be the fronter for such a captive in another line of business, or we would say, okay, we can do it, but we have considerable default risk that we are carrying. And of course, if we are having such a fragile concept, our cost of capital is much higher, because such a risk we would actually only write if we would get 7% revenue from it. And then our costs become much higher. So that's super important, this question of capital. How much do I put in? Then what does it cost, of course? Formation, operation, the fronting fees. That would be what HDI, what our department would calculate. And is there maybe something else that I would rather do with that money, that I would invest differently than in insurance? And what are my plans in the next years? And what could be the worst case? So imagine all lines of business that are placed within the captive would go to pretty much a maximum loss. What would happen? Would I, as a parent, be able and willing to refinance the captive? Would I need to put it into runoff? So these are all questions to ask before forming a captive. So it's not an easy thing. And very often it's not so easy to say, okay, look at your insurance costs and then see how much savings you can have, because it's very much a different view. A captive would create a company, a return on investment, right? It can be a profit center. Whereas if you buy insurance, it's just an expense. It's just a cost. So it's not so easy to compare these two to each other. And I feel like some clients are maybe also not advised so well. Like you also have to think about, hey, what's the interest of your advisor in that setup? Good. So to wrap it up, so captive is pretty much an insurance, or most of the time a reinsurance company that is wholly owned by its insured, and can be both primary insurer or reinsurer. And actually, yeah, most companies want to reduce the cost of risk, namely the insurance cost in such a setup. There might be other things like difficult risks and so on, but optimally you gain some profit out of running a captive. I'd say that 90% of the captive deals we write are within international programs. So there's only very few that we do that only have one local or one policy attached to it. And and the beauty of it is to kind of funnel it all so that you have to make one reinsurance agreement with your own captive, but have a lot of local policies issued all around the globe. That's why it's mainly interesting for very big multinational companies, and should, in the ideal case, be a better value than just insuring it in the normal insurance market. That said, you probably know that there are some cycles when it comes to how expensive insurance coverage is. over the past couple of years, we have observed a quite, we call it hard market, where insurance rates are quite high. Insurance premiums were quite high. We see a softening now. And of course, in the hard market, companies tend to put a lot of risks into their captives because they see that they can save a lot of money. There was also quite big captive formation activity in many jurisdictions. So a lot of companies decided in the hard market phase to have a captive, to involve their captive. This might change now that we hear that some markets are already starting to become softer. But this is only true for these types of risks where you are keen to save something. This is not true for the hard risks, for the tough risks like clinical trials and so on. So these would still go in the captives at a usual volume, actually. When captives make sense, I copied this from a brochure, actually. So this is quite generic, but I think I've touched all the cases already, the cost, the sizes, the risk itself. And when it comes to such setups and fronting deals, there's not so many companies that we are actually competing with in the insurance market, I have to admit, at HDI Global. And I wish actually there would be more so that we would be forced to up our game as well. But it's really tough. So it's always the same suspects there. So wrap up of today's session. I hope you've all understood why captive insurance or reinsurance companies are different from normal insurers and reinsurers. And I hope you understood what we offer in this traditional captive fronting realm. You will in future sessions or in the March session actually learn what other alternative risk transfer methods we also offer. And very fun is also that all of these alternative risk transfer methods you can use on top of a captive as well. And that's where it comes like advanced, like super interesting. I hope that you've understood our role as HDI Global within such an agreement and how these agreements are usually structured, how the risk is layered and distributed and who keeps what. I hope you have understood the considerations that our clients usually have before forming a captive, or also when to decide about closing a captive. We also see some clients that discontinue certain lines of business within the captive because the market just gets too easy and cheap. And I hope, as like my most important point, I hope you've understood that captive is like the most amazing topic there is in insurance, because in my everyday work, what I actually deal with is all lines of business. So I talk to the underwriters constantly, like people like Tiziano. I work with all the countries there are in our HDI Global network. I work with primary insurance problems and wordings. At the same time, I'm in charge of reinsurance problems and wordings. I have some authority for outbound reinsurance business. So I feel like captive is really a quite amazing area to work in. So if you ever get the chance to look into a captive department, do it, because you will learn so much. You will not become the most sophisticated specialist in one thing. Like you will not be like a super focused on modeling actuary. You will also not be like in the legal department, be a super expert in wording, for example, but you will develop skills that are quite broad in all of these areas, and you will become better and better. And honestly, like I joined 1.5 years ago, and after half a year, I thought, yeah, now I'm on top of things. Now I understood it. And in came the next fronting deal, and I understood nothing. It was like, what are they doing? What do they want? And it still happens, right? So I still learn tons of new things every day, and keep that in mind. It's the most interesting topic in the insurance industry, I think. I'm convinced of. Yeah, then Tiziano, you will touch a... Marco?
Before you pass the word to Tiziano, I am glad to tell you Anya, that you received from the audience not that many questions, actually just one, but a lot of compliments, saying
really?
congratulations, saying I read one out of many saying congrats, Anya, you are one of the best speakers I have ever met.
Oh,
My
thank
congratulations.
you.
So
Thank you so
it's
much. That's so kind. That's so,
no, no,
it's
no.
also
It's I can see that. I mean, you have you. It was very evident the passion you have for your profession and for the work, and why you consider. I believe that we all can agree that this is one of the most trickiest, but also more interesting part of the risk transfer of financial risk financing. I would say so. The only
yeah.
question I got from the audience is, good morning, Anya. In addition to the retrocession of risk, how can I protect in a different way the captive?
Okay, so the retrocession. So yeah, you can buy reinsurance to protect the captive. What would be the best way is actually to, at any point in time, provide enough capital from the parent to the captive so that it never runs into a situation where it is at risk of losing its license or fronting partner because it's below a certain solvency level. So this would be actually number one, provide enough capital. What could be attractive to provide enough capital? There's always the way. So if you hold this capital to reinvest it into the parent, for example, via a loan back to parent. That's what most captives do, right? So part of the money they have, they give as a loan back to the parent. We as a fronter don't like it so much because suddenly the captive's financial strength depends very much on the financial strength of the parent. But it's possible. And honestly, if the parent has a very good rating, if the parent has an A rating, we don't have that much of an issue with it. Then it's totally okay for us. So I feel like as a risk manager, you could consider having enough capital in the captive and then give a loan back to your parent. You should always understand at any point in time the size of limits you write and how they are interdependent on each other. So this is a very, very important measure to protect your captive. But usually, if you have a very good fronter, they will point out to you. So if you have a property claim in France, for example, there's very, very high likelihood that you have a business interruption in Luxembourg because they depend on each other and so on. So usually when you have a very good fronter who understands what you have in your portfolio, then this is the limit issue is kind of taken care of. But what could be an issue is if you choose and pick several fronters and maybe even have different brokers so that no one has the holistic view and you miss such a thing that your limits are kind of interdependent and so on. This could be a risk. So to protect your captive is to really be also on top of your limit structure and what you have in there. Another way of yeah, this is like the most common things I would say to protect your captive
Okay,
and
no,
the reinsurance.
very
Yeah.
clear. Very clear. I mean, they keep going, arriving. Congrats for the very passionate presentation you had. But among these, it's a couple of questions. You can answer it. You know how long it will be the Tiziano's part, so you have to adapt. If not, I will.
No,
I mean,
you
we
can
let
keep going because I think
Tiziano.
we only have a few. Uh,
Exactly. No, no.
okay.
It's a question to both of you, to Tiziano and Ioania. Can risks that are not insurable on the traditional market be transferred in case a captive is established? So, would the market accept such a transfer? I think you have told this, but if you want to
Yeah,
answer.
but it's actually a very good question because what we have to prove as a fronter, we need to prove that the captive premium is market like is consistent with the market premium. So imagine if you have a risk that is like so new and so different that there is no market premium. Then we need much more other stuff we have to do. Like we need actuarial assessments. So people really have to crunch the numbers to say, this is most probably how much this risk would cost. So you can do it. You can write really novel risks in a captive setup, but you need to find a fronter who works with you on this to do that and to accept that. And yeah, so that yeah, so that would be probably the issue. Tiziano, do you have anything to add to that?
Yes, so in this respect, this is not only related to risk that is difficult to insure on the market as a whole, but also to use the captive to maybe fill gaps that the market is not able to underwrite or is not willing to underwrite. This was mentioned, Anya, in one of the structure that we have presented, where we have seen the captive participating in the portion of the risk that is traditionally ceded to the market. What it is important to say here is that a captive, of course, it's a decision for a medium long term. I would say concept, because captives shouldn't be settled for opportunistic approach, but really as a tool, as an instrument for reinforce the risk management policies and approach. It is important, because of course it's a intensive process. It requires capital, it requires the establishment of a legal entity, the good selection of the domicile, etc. So although we are not talking about rocket science, it could be a complex process. So it is important that one decision is taken and the process is finalized. It is important to identify a stakeholder, a partner, whoever it is, hopefully HDI, but whoever it is, that is flexible and can support with the dialogue with different solution, the ongoing process of keeping a captive alive. That could be differentiating the participation of the captive, participation into risks that is normally is difficult to cede to the market. So using really a captive as an instrument, as a tool to make the risk management strategy more efficient and more effective. So really, once the captive is established, you can use, I wouldn't say in the way you like, because of course there are some restrictions and rules to comply with, but really the implementation and the usage of the captive can be very really flexible if of course you have a good company that can follow your strategy.
Mm-hmm. A lot of questions are coming together with congratulations for. I take one because it is particularly is an explanation of something that was not clear for one of our friends who has followed us. Good morning, Anya. First of all, congratulations for the very good explanation about not easy matter. Just one clarification about one slide, which is the number 18 or 17, I believe, that is captive fronting structures. And it's how does it work, this one exactly? The case captive per layer plus XL participation. So our
so
audience
this,
is not
the four,
understanding this. Yes.
Perfect. Yeah, no worries. So pretty much this is something you would usually see, like the client wants a captive layer, so wants to take the initial risk. And then very often in the access layer that would come on top of it, the broker would then run around and try to fill a panel. In some cases, they don't find enough insurers who are interested in participating. Then the captive might need to also participate in that reinsurance panel. So that would be one classic case where this structure would appear. But sometimes they might also say, so the broker finds a participant in the panel who would do it, but they find it too expensive. So they say, no, this I can write it cheaper, so I take it in my captive. This is like a reaction to the market then. And keep in mind, of course, the captive needs to have stable finances and enough capital to then jump in, right? So this would be the big captives that can pull this off. I think I have never seen it from the beginning that they would do it like structure their deal like it. I don't want to say that it's impossible. So there might be setups where this would make sense to structure it from the beginning with that goal in mind. Could maybe be for difficult reasons where they want to give a signal, maybe that this access is really attractive to participate in at this cost, at this premium. But I have never seen it actually from the beginning like that. Yeah.
Mm-hmm.
Yes. If I may add something, Marco, because was exactly the structure I was referring to when I was talking about flexibility. And I have the opportunity, if you want to say in that way, to experience in my personal life when I was on the other side, so when I was on the captive side. So together with the reason that Anya explained about the need or the opportunity to evaluate the structure, there might be other situations, like, for example, the market is not ready to follow the terms and conditions, not only the pricing of the policy itself. So in order to not to change the terms and conditions, and particularly the wording of the policy, it might be required that the captive to participate to fill the gap. Or in case, in particular, for very complex programs, it's not possible to finalize the placement till the due date, and the client don't want to postpone the due date, or the market is not available to postpone the due date, the captive can step in on also on a temporary basis to fill the gap and let continues the stakeholders, so the broker, the client itself, to going on in the negotiation even after the expiry date of the program. So when the program is already renewed. That's why I said that the captive is a very good instrument for risk management purposes, because it can be used also in those emergency cases to make sure that there is a continuity of the insurance coverage. Of course, as Anya said, making sure that the captive is adequately capitalized, and that at the end of the day, with this measure, the business sustainability of the captive and the financial sustainability of the captive is not spoiled. Reason why, and then I close up, it is also important that on a managerial level of the group the captive belongs to, particularly from the CEO, there is somehow the availability and the flexibility also when the case requires to financially sustain the captive, sometimes also with a let's say limited time window, to make sure that the captive is able to respond to the need of the particular difficult placement.
Okay. I let you, I mean, there are a lot of other questions. I have just picked up the first one of FIFO, but and one which was asking for clarification. I think we will collect them. Let you finish, Tiziano, because we just have 3 minutes. And we have to be on time for the test after. We will collect them and we will send it them to you. Of course, we will have other two webinars. The next one will be more into detail, so maybe some of them can be dealt with in the next one.
Yeah, sure. And you can provide me the question and connect on LinkedIn, please. So
sure,
we can
sure.
stay in touch.
Sure.
Yeah.
Yes. So that we can use also to craft it better the next webinar if there are some topics that we wanted to explore more. We want to have this kind of interactive webinar, because at the end of the day, the purpose is to, be ready to respond to the needs. So the other two slides, and again, I cover it very quickly, is just basically our capabilities in terms of a partner for insurance captive. We have already touched our network and the programs that we fronted that are related to the captive, as well as the flexibility. So one of the key elements that I would like to underline in the choice of the captive partner, it's really flexibility and the capability to understand the client's need and the client's priorities. And this is one of the key elements. So the choice of the fronting partner is, I would say, as important as the other critical question that Anya raised during the establishment of the captive, because it's a long process. So I wouldn't say that it's like being married with your fronting partner, but at the end of the day, the more solid and the more robust is the relationship, the more the easier is to find a solution, taking into consideration also the evolution of the market and the evolution of the client's need that are somehow unique. So there is not a standardized model that can be applicable client by client, but the idea is to have a very tailor-made approach. The last slide, Anya, is yes, it's more or less we already covered this one. So as Marco introduced, this is a path that we want to walk you through. Now we are, let's say, in the middle of the first and the second webinar, even though there are a lot of questions that maybe we will be happy to answer, that will create probably some elements for bring you at the second webinar, where we're going to have a more in-depth overview about the captive concept, how they are used in practice. And the idea is also to bring the risk management, the risk manager's point of view, to be let's say really proactive on our webinar. And the third webinar will be more, let's say, sophisticated. So from let's say from the ground, I would say, to the stars, so to the alternative risk transfer tools and features. So how really you can diversify your risk management approach with the captive, but also without the captive, because some of those tools do not necessarily require a captive to be implemented.
Very good. So it's once again I remind all of you the dates of our next meetings. So to say, so the 25th of February will be the captive concept usually into practice and risk managers' perspective on captives. And the third webinar on alternative risk transfer techniques on the 25th of March. We will, of course, gather all the questions that have come, which we didn't have the time to deal with it. I thanks very much once again both Anya and Tiziano for the very good presentation. Luckily, we have other two occasions to at least one to deal with this captive concept. By the way, captives means it comes from the Latin captivus, that means prisoner. No, so it's a company that is bound to deal its own fully owned by by an industrial company, by a commercial company. So it's once again something also regarding the name, of course. And being an engineer, I always start with definitions and names. So it's good to end with that. And I leave the word to Luca to introduce the test. You are on mute, Luca.
Ecco, ovviamente stavo parlando, ma nessuno mi
Sorry, do I need to remain online for the test as well? Or because I think I know all the answers. Or can I already hang up?
You can hang out, Anya. No problem. No problem.
But then I would like to say thank you everyone. I'm happy to connect on LinkedIn, and I hope I will be able to answer all your questions.
Thanks again.
Awesome. Thank you so much. Have a good one. Bye bye. Bye.
Io ne approfitto per switchare appunto all'italiano, ringraziando ovviamente i nostri illustri relatori per aver dato vita a questo primo webinar del 2025, il primo appuntamento di approfondimento al quale poi ricorro, come hanno fatto Marco, il moderatore di oggi, e i relatori seguiranno gli appuntamenti del 25 febbraio e del 25 marzo. Ringrazio naturalmente la dottoressa De Marta e il dottor Toffolo per l'ottimo contributo, sono stati quest'oggi veramente il motore di questo interessantissimo webinar, quindi thank you very much. Grazie Marco Terzago, come sempre, eccellente e coinvolgente moderatore. Sono arrivate tantissime domande e numerosissimi complimenti per gli speaker. Non siamo, per quanto riguarda le domande, non siamo riusciti a rispondere a tutti, però sono domande che inoltreremo ai relatori affinché poi possano fornirvi una risposta a seguito del webinar. Per coloro che sono interessati a effettuare il test ai fini della certificazione RUIVAS, ricordo che l'aula è aperta e rimarrà aperta per almeno 20 minuti. Da parte di tutta Arra, grazie ancora per essere stati con noi e arrivederci al prossimo appuntamento.
Grazie a tutti e buona giornata, buon lavoro.